Hi, everyone. I'm Jeff Panik with Balanced Wealth Partners. With a bit of time left in 2025, now is the perfect time to review year end tax strategies that could significantly impact your financial future. Today, we're covering four powerful strategies that high earners and retirees should consider before December 31st: Roth IRA conversions, backdoor Roth opportunities, tax loss harvesting, and charitable giving strategies. Roth IRA conversions. Let's start with Roth IRA conversions, which have become even more attractive following the One Big Beautiful Bill Act signed in July of 2025. This legislation permanently extended the current tax brackets through 2026 and beyond, giving us clarity on tax rates for conversion planning. A Roth conversion enables you to transfer funds from traditional retirement accounts to a Roth IRA, allowing you to pay taxes at potentially lower rates now and enjoy tax free withdrawals later. Here's the key: there are no income limits on conversions, making this strategy available to everyone regardless of earnings. The sweet spot for conversions is often between retirement and age 73 when required minimum distributions begin. For example, if you're single with $150,000 in income, you're in the 24% bracket. You could convert up to $47,300 more and still stay in that same bracket, since the next bracket doesn't start until $197,300. Three Roth conversion strategies to consider. First, fill up your tax bracket. Convert just enough to reach the top of your current bracket without jumping to the next one. Second, spread conversions over multiple years to manage the tax impact and avoid Medicare surcharges. Third, time conversion strategically. Convert when the markets are down or during lower income years to minimize the tax hit. Remember, you must complete conversions by December 31st. There's no extension like regular IRA contributions. Backdoor Roth opportunities. Now let's talk about backdoor Roth strategies, which are crucial for high earners who exceed direct Roth contribution limits. For 2025, you can only contribute directly to a Roth IRA if your modified adjusted gross income is under 150,000 for single filers or 236,000 for married couples. Above these limits, you're completely phased out at 165,000 and 246,000 respectively. But here's the workaround: the backdoor Roth IRA. You contribute up to 7,000 to a non-deductible traditional IRA or 8,000 if you're over 50, then immediately convert it to a Roth IRA. There are no income limits on this strategy. For those with access to specific 401k plans, there's also a mega backdoor Roth, which can allow contributions of up to 70,000 for those under 50 or 77,500 for those over 50. This requires your employer plan to allow after-tax contributions and in-service withdrawals or conversions. Critical warning though: the backdoor Roth works best if you don't have existing traditional IRA balances due to the pro rata rule, which can create unexpected tax complications. Tax loss harvesting. Tax loss harvesting is your opportunity to turn market volatility into tax savings. This strategy involves selling investments at a loss to offset capital gains and reduce taxable income. Here's how it works: you can use capital losses to first offset capital gains dollar for dollar. If your losses exceed your gains, you can deduct up to $3,000 against your ordinary income annually, with any excess carried forward indefinitely. The key is timing. All tax loss harvesting transactions must be completed and settled by December 31st. Two important considerations. First, be aware of the wash sale rule. You can't repurchase the same or substantially identical securities within 30 days before or after the sale. Second, prioritize harvesting short term losses first, as they offset short term gains that are taxed as ordinary income at rates up to 40.8% when you include the net investment income tax. Recent market volatility in 2025 has created significant harvesting opportunities, particularly in municipal bonds and certain sector ETFs. If you haven't been harvesting losses throughout the year, now's the time to review your portfolio systematically. Charitable giving strategies. Finally, let's discuss charitable giving, where significant changes are coming in 2026 that make 2025 a critical planning year. Under current rules for 2025, you can deduct cash donations of up to 60% of your adjusted gross income and appreciated assets up to 30%. But starting in 2026, new rules create a charitable deduction floor. You'll only be able to deduct contributions exceeding 0.5% of your AGI. This means 2025 is the last year to maximize deductions under current rules. Consider bunching multiple years of giving into 2025 to maximize your benefits. For those 70 and a half or older, qualified charitable distributions remain powerful. In 2025, you can donate up to 108,000 directly from your IRA to qualified charities, altogether avoiding income tax on the distribution. For married couples, each spouse can contribute to this limit. Three advanced charitable strategies. First, donate appreciated securities instead of cash. You'll potentially avoid capital gains tax while getting the full market value deduction. Second, consider donor advised funds for immediate deductions while retaining flexibility on when to recommend grants to specific charities. Third, if you're facing a high income year, accelerate your giving to take advantage of the full 60% AGI deduction limit before the new restrictions take effect. These four strategies, Roth conversions, backdoor Roth contributions, tax loss harvesting, and strategic charitable giving, can significantly impact your tax liability and long-term wealth building. But they all require action before December 31st of 2025. The key is coordinating these strategies based on your unique situation.